Welcome to A to Zephyr with Ryan Nauman from Zephyr. In this podcast, we help wealth managers, financial advisors, and asset managers overcome challenges in creating meaningful investor relationship experiences. We do this by introducing innovations driven by Zephyr's cutting-edge technology and global financial insights. Join us for this journey where we dive into pioneering wealth management strategies as Zephyr draws from decades of experience and guest financial wizards to address the nuances of investment management.
Welcome to the A to Zephyr podcast. For those of you joining us for the first time and may not know the benefits that Zephyr offers within the wealth management industry, let's give you a quick high-level overview. Zephyr is an investment management tool software used by financial advisors, wealth managers, asset managers, financial analysts, RIAs, and trust advisors. This podcast addresses the many ways that your peers in the industry use it. Zephyr allows its customers to optimize portfolios, identify risk tolerance, ensure compliance, evaluate performance, and proposal generations, and more. In fact, it allows you to communicate with your clients to turn your prospects into clients. So welcome. We're glad to have you on board. Joining us today is Chris Volpe, Director of Zephyr Zephyr. Randy Jones, Director of Product Management at Zephyr, and Ryan Nauman, Market Strategist at Zephyr. Gentlemen, really good to see you all again. How you been?
Great to see you again, Bill. Thanks for having us again and listening to us talk about some really interesting stuff.
Well, you know, people talk about AI all the time, like just got invented last week.
I know we're not talking about AI, but I had a great conversation with somebody. I was just at the Wealth Management Edge conference, and the guy said basically the same thing. He's like, remember back when Microsoft had that little paperclip, right?
Yeah.
And it would say, it looks like you're typing a memo. Do you want help? Right. So back when, and I just dated myself, I'm sure, but way back when, Microsoft had it already, and now all of a sudden it's new, but whatever.
Well, no, and the link is here because Zephyr, the management tools offered by Zephyr, actually, in a lot of ways, predated this whole AI conversation because it allows folks to do a whole lot of things that are actually really interesting, as anybody who knows who's been listening to the podcast or who's familiar with the software system. In fact, Chris, let's start with you with the question about how does matching an investment to the unique investment objective as a client help build trust between the client and the advisor? It seems like it'd be kind of an obvious answer, but I'm curious to hear yours.
Well, it's sort of interesting as the market and as advisory overall has evolved, right? Originally, you had a financial advisor who was picking his own stocks and mutual funds that fit your portfolio.
Yeah.
Right. And so he had to screen through, 10,000 different mutual funds to find the one that fit your risk score or everything else. Right. And then sort of the move was to model portfolios. Right. And so, the portfolio itself, the model portfolio that was provided by an asset manager, right? Everything, the underlying investments were already picked. And it just had to align with their risk tolerance and their goals. And now it's moving much more closer to a personalization, right? Where you might start with a model of and that may be okay for some people, right? Mass affluent or people just starting out. But as you get into the higher net worth, right, understanding the uniqueness and, to your point, the unique investment objectives, and then matching not just the model portfolio, but then looking at the underlying investments and how they match is becoming really important in the personalization world. And in the end, that's how you build trust, right? By understanding somebody's unique situation, somebody's unique position, right? And then tailoring the portfolio, the reporting, the investment management, all of that to them specifically. And that's where the personalization comes in. So if you're matching somebody up to a model portfolio and you can't articulate how that aligns specifically to unique goals, then, even from a consumer perspective, right? If someone did that to me, I'd feel like, geez, I'm just another person. I'm just a number in their world. That's the rationale behind it.
Well, no, I'm reacting to this as a consumer, as a matter of fact. And I think a lot of the time, granted, I can be a little bit cynical about all of this stuff, but I sit down and somebody says, well, here's your survey and your risk profile and stuff matches this model. And I'm like, I can't see this model. I don't understand this model. And I feel like I've gotten a one size fits all kind of
It's a
solution.
great way to put it.
you know, and it's a little unnerving for me on the consumer side because it's like, okay, all right, well, Ryan, let's go to you with what are some of the key considerations that a financial advisor should make when searching for an investment that meets the client's unique objectives, like say me.
Thanks for having us, Bill. And that's a great question. For all of our audience who've listened to the previous 7 episodes, they'll realize just how important personalization is. Chris talked about it just now. It seems like every episode we talk about the importance of personalization, whether, like Chris said, it's through reporting, the service financial advisors offer, or their investments. And that's really the first step and most important. Make sure you understand the client's investment objective so you know what type of return, risk, or qualitative characteristics you need to look for in a manager. So, Bill, if I'm looking for a investment for you, the first thing I need to do is sit down and understand exactly what you're looking for and what your objectives are. Do you want to invest in your values? What are those values and beliefs? So I can do the best I can in aligning and finding those investments for you. For example, and Chris talked about it, what is your client risk? Is your client risk averse? If so, then make sure you're searching for managers who are able to protect against losses. Look for managers with a low pain index or low maximum drawdowns. Or if your client wants to invest in managers who focus on companies who limit their carbon footprint, look for managers with solid environmental scores and look at underlying holdings to make sure they align with your client's wishes. You have to know what you're looking for in order to find it. So, and additionally, make sure the manager is doing what its stated objective and philosophy is. Make sure it is following its mandates. Mm-hmm. For example, Bill, if you want a value manager, something that's, buy investments at a discount, make sure the performance of that manager behaves like a value manager and not a growth manager. And that behavior and performance is consistent with its style. Even if this style is out of favor and it's underperforming, is that manager consistent and does it have conviction to that style? Those are some of the things financial advisors should look for and consider when looking for that perfect investment.
Yeah. And this seems like a perfect point to turn to Randy, because Randy, can you give us some examples of how Zephyr users use Zephyr to search and locate managers that meet their client investment objectives like Ryan was just talking about?
Oh, sure. Pleasure to be back, Bill. Probably focus on four examples. So the first, I think in our previous podcast, we talked about our clients using our asset allocation modeling. Mm-hmm. It's an area in Zephyr that helps our clients determine what strategies and allocations they'll apply to a potential portfolio. And more often than not, they're using indexes as the proxies for the strategy. So they'll have maybe a small cap, mid cap, large cap, fixed income, but they'll use benchmarks to represent the actual strategy. Once they've done the modeling and determined the mix, what strategies they'll invest in, they'll go to the screening tool and then find the best manager to fit each of those strategies. So if, say, large cap value will be one of the strategies that the model has predicted or what they've selected, now they'll go into the screening tool using any number of qualitative and quantitative fields to actually find the best managers and products to fit the large cap value. And they'll do that for each of the strategies that they applied in the modeling, where they go from using indexes to actually looking for the best products and managers to fit the bill. Number two, as Ryan mentioned, would be a new mandate. If our client's client is researching real estate and they're interested in real estate investment trusts, for example, then the screening tool will be used to go find the best managers and products for REITs, for example. Number three would be replacing a manager. So we see, on the institutional side and the retail side, frequently managers and products will be replaced for any number of reasons. So this, if we're hiring a new mandate, not just a new mandate, but replacing a manager in a specific asset class or strategy with a specific objective, our clients will use our screening tool to do that. And then number four on the asset manager side is really to find your top competitors. So if I am a large cap value manager and I want to screen on the fields and the strengths that I have as a manager in my products, I will quickly put together a list of similar, managers and products that are probably my top competitors. So those are really the four. It's a great extension of the asset allocation modeling, finding new mandates, replacing mandates, or, from an asset management perspective, doing some deeper competitive analysis.
Yeah, no, it's interesting. And Ryan, can you provide us with maybe a couple of questions or examples of questions a financial advisor should get answered when conducting a manager search or doing their due diligence?
Yeah, Bill, it goes back to the original question too, is, a lot of these different questions that you ask during a manager search or doing your research or due diligence depends on what type of manager you're looking for and what value you put on some of these questions and what you're looking for. There's qualitative and quantitative questions that you can ask a manager. And like Randy was saying, a lot of the quantitative and qualitative can be found within Zephyr, whether it's the PSN universe or PSN database, or just all the different investment metrics Zephyr calculates. So a lot of these questions or answers to these questions can be found using a tool like Zephyr. Some of the ones that I think are most important on the qualitative side is, where does the investment management team find market inefficiencies? Does the view on those market inefficiencies remain consistent through all market environments? Like I said earlier, during times when maybe your investment style, like large value, it's been out of favor, large growth has been outperforming and kicking its tail for many years now, or is the manager, is he or she going to change their investment methodology to try and capitalize on that new hot investment style or sector? You talked about AI. Maybe the manager isn't supposed to invest in technology, but they see the performance in AI. Now all of a sudden, are they shifting their investment style to capitalize on it? Those are the types of things you want to find out there. And this tells you how committed they are to this style and consistency. Another one is just the investment team, its tenure, its experience.
Yeah.
And find out more about that team and their experience. And does the investment expertise align with the client's investment objective? Does your client want sustainable investing or charitable giving or tax management? Make sure that investment team has expertise in those areas. Then on the quantitative side, like Randy was talking about, do the investment analytics align with the investment objectives and strategy mandates? If the investment objective is to preserve capital, do analytics like the Zephyr pain index, Zephyr pain ratio, maximum drawdown, downside deviation, you name it, do those analytics confirm the story? If those analytics don't align with the investment objective, then why? Why don't they? Get those type of answers. What happened? And lastly, look for performance outliers that might be inconsistent to long-term trends. Your manager ranked in the top quartile for alpha against its peers for 5 years, but all of a sudden it underperformed and was in the last. Why? What happened there? Why did it underperform, or why was there a huge surge in performance during that one quarter? Those are the types of things you want to find out is, what happened? Why wasn't it consistent? Is it consistent to its style?
Yeah, and this may be a huge assumption on my part, but I'm thinking, holy cow, this is great. Well, there's a lot of time. This is time. There's a lot of consumption of time. And I would imagine most of the folks listening to this podcast, Randy, think, okay, this is all cool. This is all great. It's all important stuff. But can Zephyr help me reduce the time? Looking through the manager search and the due diligence. How does Zephyr do that, or can it do that?
Oh, it absolutely can. So our screening module is very powerful and very efficient. So for our clients mostly, so they still focus if I'm going to do a screen that we talked about earlier, new mandate, filling a strategy, doing competitive analysis, our clients still focus on the 4 Ps, right? People, philosophy, process, performance, which includes risk. We have hundreds of qualitative fields on the first three Ps, and then all of our statistics. They can search for those, so they can find the actual criteria quickly. And then let's say we're looking for a mutual fund and just keep it a large cap value. I could start with a database of 26,000 products and narrow it down to a handful in probably 5 to 10 minutes. So we make it easy for our clients to select the criteria, both qualitative and quantitative, that are important and are typically around the 4 Ps. And then using those as filters, narrow that database down to a handful that they'll do further due diligence on. And then from there, so let's say we end up with 5 potential products out of 26,000. In our other modules, we make it easy for our clients to select. So what they've essentially created was a little universe that will now be their finalists that they're screening on, that they like to do even further due diligence on with our other modules and customized reporting tools. We make it very easy for them to just select that little universe and populate the report or the analysis that they're going to do further. So the screen itself contains hundreds of potential fields. They're easy to select, and using them as filters, we can literally narrow down thousands of potential products to a handful in a matter of minutes, and then easily take that due diligence further in the other modules of Zephyr.
Yeah, this sounds efficient. I mean, I was sitting here listening to Ryan thinking, this sounds like most of my day. I'm sitting down on this.
But maybe part of your lunch hour, but not most of your day.
Yeah, no, that's great. So, Chris, you have any final thoughts on the importance of creating an efficient screening and research process that gives a financial advisor the best opportunity to locate the investments that best match their investors' demands?
Yeah, I think the big message I would say is that you're not alone, right? We help customers all the time. Ryan can go through and work with customers. And while we're not going to make recommendations, Ryan can work with them on, what they should be looking at, what the statistics really mean, how they can better make it, and how they can better align the portfolios. I mean, he does a really good job with that, and always willing to talk to customers. At least I hope I haven't said that. And he's like, I can't believe Chris said that.
Ryan's sitting there, he's making faces. I don't know if you can see him or not, but he's
no, but and the other side to that is there are hundreds of ways that you can screen. And so not only can we help you choose the important ones with Ryan kind of walking you through a little bit of what's important and everything else, our client services team does training on our modules all the time. And if someone wants to start with a small screen or whatever they want to do, we would be happy to walk them through it. Everybody uses simple stock screeners, right? I mean, Yahoo Finance uses simple stock screener. When you get into the more qualitative measurements and things like that, it's a little bit harder to understand and know. And so not just setting up the process, but also understanding what you're looking for and why you're looking for it, because that directly translates in how you explain it to your client, right? Yeah. Like, I didn't choose XYZ manager that you've seen on the news a million times because of the tenure of their staff, the style that they're working with. We can help you with all that as well. So I think, the underlying theme is you're not alone. We're here to help you. The more that you can do that for your clients, the better the trust, the more retention, and they will potentially give you even more assets. So,
yeah, it would seem to me that like a key component here is a word kind of danced around a little bit, but it gives, and you just sort of touched on it, Chris, it gives transparency so that, an advisor can say, yeah, this is exactly why I've run the research and this is why we're going to do what we're doing. And I would imagine, Ryan, since you interact with a lot of the customers, they find that probably the most valuable piece of the whole deal, I would think.
Yeah, it is transparency. And then it goes back to trust, that transparency. If you offer transparency into your process, into your thinking, into the investments you're offering that show that we have your best interest at heart, we are looking out for you and your investment objectives, that goes to building trust, like Chris said, which leads to better client relationships, more assets under management, and more referrals. So it really all leads to trust. And it starts with searching and leveraging data and analytics to find that perfect fit of an investment that meets those unique investment needs of your clients.
And I'll just jump ahead, Bill, because I also think, like, not only is it around personalization and trust, right? But there's a regulatory change out there now too, that advisors have to act as fiduciaries. So if you can't do that, if you can't explain why you've done what you've done and why it's in the best interest of your client, as Ryan says, you potentially are opening yourself up.
Well, yeah, I mean, look, and I'm speaking as a consumer on the consumer side of this whole deal. I expect that transparency, and you're right. I mean, all of you are right. If you can't tell me why, it'd be a real answer. Yeah, I'm more likely to leave than I am to stay, as a matter of fact.
Bill, over the past, 5-10 years, it's been this huge push for fees, right? Yeah. The race to zero. 20 years ago, maybe it wasn't that big of a deal. If you're producing solid returns, you can overlook those fees. But now it's all about disclosures and transparency. If you're not producing returns and you're charging higher fees, then those clients are going to move along too, right? So there's that transparency and do what's in the best interest of your client. And you can't charge 1% anymore. So you've got to do other things to increase that client relationship.
Yeah, no. And speaking of which, anybody wants to have a client relationship, anybody in the investment community is listening to this and want to reach out and talk to the folks, to all of y'all, what is the best way for them to do that?
Well, Ryan's home number is
contact Ryan.
His home address and his cell phone number are.
Yeah, look, there's a various ways that you could reach out, right? You could reach out through our client services group. In Zephyr itself, there's training available. We run regular training seminars where we'll go through a lot of this stuff, and you can sign up either through the product or go to our website, look at the schedule and sign up for it. But just reach out to anybody and we'll get you to the right people.
That's great. Well, thanks for this quick visit, guys. Really appreciate it. For those of you who are listening to the podcast and who have not listened before, there are 7 episodes part of this one you can go back and check out. The best thing you could do, though, is just become a subscriber, and that's easy. Hit the follow button. That way, every time a new episode of this podcast is dropped, you can listen to it. The thing I would ask is, if you are listening to this podcast, you find this information interesting, you find it useful, you think there is value in it, share it with other people, share it with other advisors, share with other people that you know, because word of mouth is always a welcome promotion tool. So thank you very much. On behalf of everybody at Zephyr, I'm Bill Tucker, thanking you for taking the time to listen today. Chris, Brandy, Ryan, thank you. Well, I appreciate it. And I want to remind everybody, you can go out today and make today a great day or not. It's your choice. It's up to you. Have a great day. Until next time.
Thank you for listening to A to Zephyr. Click the follow button to be notified when new episodes become available, and be sure to check today's show notes on how you can get in touch with us. Once again, thank you for listening. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Zephyr. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.